Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita, Khemka, and my colleague.
Hello there, I am Yatin, Mota.
Well, Yatin, a very good-looking screen.
Yes.
Fantastic Friday, so to say, after almost, in fact, over a week of roller coaster ride. Wild, crazy swings in the market globally, although global markets aren't doing all that well because they've already digested the news around the pause on that 90-day pause on the reciprocal tariff. But we reopened today for trade, and despite weak global cues, despite sharp fall in US stocks once again overnight, we saw very good traction. We saw 2% kind of an up move. In fact, the Nifty tested 22,900 on the upside.
Yes.
At one point of time, it was looking like we will reclaim that 23,000 mark. Didn't happen, didn't really happen, but nothing to complain about. Still, we managed to clock a very strong rally on the Nifty. We ended above that 22,800 mark. Over 400 point up move, the Sensex as well, 1300 point up move there, 75,000 on the Sensex. So yes, a good looking screen. Mid and small cap indices as well gained anywhere between 2 to 3% apiece. All the sectors were trading sharply higher, but led by metals. Metal index was up somewhere around 4% or thereabouts. You also had FMCG pack doing well, Yatin, on Wednesday as well. That was one pocket that managed to stand out in a weak market, and today as well, the index has seen almost 1% kind of a gain. In fact, for the week, I was going through the weekly gainers. You will find a lot of these FMCG names, the likes of HUL, Titan, Nestle. These are the big gainers on a weekly basis, 5% each for HUL, Titan, Nestle. As well, ITC as well among the gainers. But talking particularly about today's trade, it's largely now China versus US, right?
Absolutely.
145% from US tariff on China, and China has also ratcheted up pressure, 125% now on US goods effective 12th of April. But aside of that, let's also talk about the flows picture. Yatin, the tariff turmoil has taken a toll on equity mutual fund flows. 25,000 crore rupees for March. I think the figure was somewhere around 40,000 crore rupees in October, right?
Yes.
So yes, it has come down significantly, but SIP flows, although have moderated, but are still steady. Steady, yeah.
Month on month, I think it is good, and this is despite the fact that Nandita, March is a month of tax planning.
Yeah.
You usually sell your shares, mutual funds in order to pay advance taxes. You also plan your full financial year, in March. So. Given the fact that the market was volatile in March, a lot of tax planning went into March. It's a good month for mutual funds. Nothing to really complain. But yes, as we progress into the next few months with this kind of volatility, whether or not these kind of flows sustain, these kind of SIP sustain is something that we'll be watching out for, because for the month of March, 51 lakh SIP accounts have closed. Obviously, it happens on a net basis. You need to look at granular figures also here. But the gross number remains broadly, around the 24,000, 25,000 crores mark.
Sure. So steady flows when it comes to SIPs. But in terms of individual movers, then let's take a look at some of the names. Metals dominating the list. As I mentioned, that's the top sectoral mover for today. So Hindalco, Tata Steel, JSW Steel, Coal India, all of them among top gainers. Jio Financial also doing well today. In fact, a lot of these stocks on the Nifty 50 were on the gaining side. Just about 3 losers, Apollo Hospital, Asian Paints and TCS. Of course, numbers weren't all that great. It was disappointing. We'll take stock of the numbers and what the street verdict is on TCS. But all in all, a great day of trade, Yatin. And there were quite a few movers when it comes to the mid-cap end of the markets as well. For instance, something like a PI Industries, clocked in double-digit gains. Beneficiary, right, of the escalating trade tensions between US and China.
Yes.
Take us through some of the other movers as well.
So, the advance decline ratio is healthy, almost 8:1. So, 8 stocks gaining for 1 declining. Mid and small cap indices up 2 to 3%. What was moving in the mid cap space was Gravita up 16%, Jubilant, Pharma. We had the likes of Syrma, SGS, LT Foods. All of these stocks moving anywhere between 10 to 15%. What was not doing well is Muthoot Finance after the RBI, consultation paper on gold loans. Some bit of slowdown is expected in the NBFC book. So Muthoot Finance down 6% after a volatile day before yesterday as well. ICIci, Lombard, Jyothy Laboratories, ICICI Pru Life. So the life insurance guys, the general insurance guys also witnessing some bit of selling. But stocks like Coromandel International and Chambal Fertilizers from the fertilizer pack, these are the 2 stocks which gained, and not only gained, they are now at a fresh multi-year high.
Okay, those were the movers and shakers when it comes to the broader end of the markets. But let's take stock of all the stocks that are on our radar this afternoon, starting with TCS. Technology bellwether kick-started the earnings season not on such a great note, subdued note. It missed expectations in terms of margins by 30 basis points. Q4 overall was below expectations, but the silver lining was the order book. The total contract value for the fourth quarter came in at $12.2 billion that managed to beat expectations. On a quarter-on-quarter basis, the deal TCV was up somewhere around 20%. So in such a downbeat scenario, the deal wins have been strong, and that's why if you look at the EPS cuts coming in from brokerages have only been in the range of 3 to 3.5%, and no major downgrades coming in, Yatin. They have maintained their calls, although they have slashed target prices, but not by too much. Some of the brokerages have in fact gone ahead and even upgraded TCS, citing valuation comfort after the kind of correction that some of these IT names have seen. But in terms of management commentary, they have said that the early signs of recovery that were that they witnessed in the last quarter, they have kind of fizzled out now, and that's evident, right, because of the kind of tariff wars and turmoil that is really gripping the global markets, and the whole scenario is such that nothing is really certain going forward. But even then, management has maintained that FY26 will be better than FY25 despite this short-term uncertainty. In fact, they have not seen any major deal cancellation. There have been deal ramp downs, but no major cancellation as of now. There are delays in decision making as well as a result of the tariff tantrums. Tactical interventions did impact margins, and guiding margin beacon now becomes somewhere around 26 to 28%. Retail, travel, hospitality and auto sector, these are some of the sectors that have been impacted by the uncertainty. In fact, Kotak Institutional has said that the impact of tariff turmoil will be witnessed in the first half for some of these IT measures, but the first half tends to be strong quarters for IT names. So that's something that could be a bit of a worry, but second half onwards, most of the brokerages and analysts I spoke to have said that things could improve going forward. Motilal Oswal has also said that the revenue risks are there, but margin recovery could support earnings. Margins are expected to recover due to cost optimization efforts by the company. Also, revenues will be hurt because of the absence of BSNL deal related income. So that's something that is something that will be watching, that Motilal Oswal will be watching out for, and that's why they have maintained their cautious stance on the stock. Antique, on the other hand, has upgraded the stock to buy due to the inexpensive valuations, because the stock has corrected 30% from its peak. If you look at the global brokerages, they have said that if you look at Nomura, they have retained their neutral rating. Target price, however, has been cut to 3,490 rupees per share. They have pointed out that there are more misses than hits in the fourth quarter, and according to them, the growth visibility for FY26 does remain hazy. They've cut their FY26 to FY27 EPS estimates by 3%, 2 to 3%, so to say. Goldman Sachs, on the other hand, has maintained buy rating and target price. It's somewhere around 3,960 or so. They've also reduced the FY26 to FY27 revenue estimates by up to 3%. Jeffries, they came with a very downbeat report on IT on Wednesday, wherein they had cut target prices for companies anywhere between 5 to 37%. But for TCS, I think they had cut their target price by 5% or so. So that target is somewhere around 3,400 rupees per share now. And they are also cutting their EPS estimates for 26-27 by 3.5%. And they are expecting an 8% EPS compounded annual growth rate over FY26 to FY28. So all in all, it is a downbeat, but there are hopes that second half onwards things will improve, because there are also hopes that India and US will thrash out a bilateral trade agreement before that 90-day pause period ends. So yes, I mean, not that bleak, but of course the uncertainty is expected to weigh. Remember, Infosys also reports numbers next week, and if they suspend their guidance, that could be a negative. I think that will give us an indication as to how bleak things are for IT. But if they give guidance, I think that means things would be okay.
Yeah, I think TCS doesn't give guidance, so Wipro, HCL and Infosys are the three stocks really to follow on that guidance front. Obviously, TCS hasn't spoken much about the slowdown or a probable impact of tariffs and the trade war. But yes, the markets are already priced in, the entire scenario, Nandita. IT stocks have already corrected 20%, 25% from the peaks. And TCS there, it was a range-bound trade, 0.5% down, 0.5% up throughout the day. So no real impact, on the results as such on TCS, because probably the market has priced in this kind of a slowdown. But moving from, IT to the gas sector, because IGL, MGL are the stocks which have been in news last week as well. IGL, MGL, obviously they have raised the CNG prices in NCR as well as in Maharashtra. But again, today analyst indicated that the APM gas supplies for both of these players, including the city gas distribution players, could be cut from earlier 50% to a level of 40%. Because the APM allocation gets cut to city gas distribution companies, this would mean higher costs for city gas distribution players, given the fact that the earlier hikes haven't seen a price increase relatively to the customers, because the price pass on has been slower. Analysts do fear that this might impact the margins again by 2 to 3% on an absolute basis. Analysts also believe that the replacement is likely from the new well gas fields, which is almost 12% of oil prices in terms of calculation. Now, with the new well focus from the government, because there are a lot of companies, including ONGC, Oil India, which have been exploring new gases from marginal fields and new fields, that could be replaced by the APM gas, which is cheaper in nature, fully in the next 3 to 5 quarters. So clearly, city gas distribution companies will remain under focus, because on one hand, we have governments like Delhi, which have been converting their fleets into fully electric from CNG, and also the APM gas supplies, the overall quota for city gas distribution companies have been lowered by the government on a gradual basis, replaced by a higher cost gas which comes from the new field. So gas stocks in particular have seen some bit of pressure in trade today, and IGL also in a market like this was almost flat in trade. MGL obviously after the news came in was down in trade, but it managed to recover intraday. But overall, a bleak day in terms of stock movement in trade today for IGL and MGL.
That's true. I think this is one pocket that has been very reactive to news flow, and in terms of APM gas allocation in particular. But still, I think the stocks have done well to recover from October lows. But here on, of course, the cost of procuring gas, that would of course determine whether or not it will have an impact in terms of earnings or not. But of course, price hikes, as Yatin mentioned, hasn't been commensurate to the reduction in APM gas as well. But another pocket that was hogging the limelight today was the entire tire sector, Yatin. They were on a roll today. The likes of MRF, CEAT, Apollo tires, all of them were up anywhere between 3 to 4% apiece. Of course, CLSA has initiated coverage on some of these tire names. I'll just take you through their calls on some of these stocks. Overweight call on MRF. Target price at 1,28,599 rupees per share, which is implying an upside of 14% from Wednesday's close price. For Apollo tires, they have a high conviction outperform rating. Target price is at 566 rupees. Potential upside of 38% from Wednesday's close price, and so goes for CEAT. Here they see an upside of 30% from Wednesday's close price, which is at 3,493, and the call here is outperform. Now, CLSA believes that the Indian tire market, which is valued at about $12 billion, is improving structurally in terms of profitability as well as capital efficiency. And this change is being driven by rising pricing discipline, better product quality, as well as improved product mix. Now, tire sector margin cycle, they believe that is also bottoming out, and they are also expecting gross margin to improve. Now, this shift, in fact, the shift is expected to favor higher margin passenger car radials, driven by rising number of passenger vehicles on the road. In fact, there has been or there will be a shift in product mix. That's what CLSA is saying, which will be driven by more passenger cars, on the roads because of more people buying cars. Now, car ownership is expected to grow across urban as well as semi-urban areas, and demand for passenger car radials is expected to go up. Now, this will improve overall margins because PCR tires are high margin for these companies. So that's something that will aid profitability for tire manufacturers. And as I mentioned, they believe that the sector is at the bottom of the of its margin cycle as well, which is why they're saying that gross margins are only expected to improve from here. That will also be aided by a softening of commodity prices going forward. And if you look at the free cash flow for the sector, that also tends to be resilient to revenue growth trends, and they are more reactive to margin trends.
Yes.
And as margins pick up, free cash flow is also expected to improve for some of these tire companies. And these factors will also improve valuations when you look at FY26 and FY27 going forward. Looking at the tire names, most of them have come off quite a bit from their peaks. MRF is down almost 20%. Fiat and Apollo are down anywhere between 20 to 30% from their peak. So yes, the potential margin improvement due to a shift in product mix or improvement in product mix is something that will aid earnings for some of these companies. That's according to CLSA, and which is why they have initiated coverage here, with outperform and high conviction outperform kind of ratings on some of these stocks.
Absolutely, and we have seen the tire stocks typically follow the trend in the auto sector. So, when auto stocks were correcting, all of these auto ancillaries were correcting, especially the ones with the US exposure, the likes of Motherson, Samvardhana, or probably Sona, BLW. Tire stocks, however, have seen a good uptick in the recent 4-5 days, especially after today's CLSA report.
That's true. Well, those were all the stocks on our radar, but we are ending the week on a good note, Yatin. We flattened out. Given the kind of wild swings we saw in the market, one would have thought that we'll end the week with deep cuts. But thankfully, that hasn't happened. Just about 0.5% down for the week. I think, in fact, since the time the tariff tantrum really started, announcements came in. I think Nifty is down how much? 500 points, if not more than
much,
that.
Yes.
Yeah, so we have been resilient in the face of all the shocks that Trump has been giving us on a daily basis. And of course, the big point is that next week is a truncated week with 3 working days. So, let's see whether or not the kind of rally that we saw today extends into next week or not, whether people are just, buying, bargain hunting in a weak market. Are they going to cut their positions on rallies? That's something that we need to watch out for. But for now, nothing to complain. We are happy ending the week above that 22,800 mark. But with that, completely timed out. From me and Yatin, thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and have a great weekend.